Welcome back to Trader DNA. In this video, we're going to share 3 effective ways to use the moving average indicator to generate accurate and reliable trade signals. Understanding moving averages is absolutely essential for every trader, no exceptions. There's not a single successful trader out there who doesn't have a solid grasp of how moving averages work. Similarly, there isn't a fund manager operating in the Forex or stock markets who doesn't rely on this key indicator to guide their decisions. Simply put, if you want to achieve success as a trader, you must fully understand moving averages. That's non-negotiable. In this video, I'll break it all down for you step by step. By the time you've watched this video to the end, you'll have a clear and accurate understanding of moving averages and how to use them effectively. This will help you avoid unnecessary losses and maximize your trading profits. You'll know exactly when to enter the market, just like professional and successful traders do. So let's start with the basics. What is a moving average? A moving average is a simple yet powerful technical indicator that calculates the average closing price of an asset over a specific period of time. For example, a 10-period moving average calculates the average closing price of the last 10 candles. One of the main benefits of using a moving average is its ability to filter out market noise, allowing traders to focus on a clearer picture of the overall trend. It's an invaluable tool for anyone serious about mastering the markets. Different types of moving averages are used to analyze different trends in the market. For instance, a 200-period moving average is typically used to identify the long-term trend of an asset or market. It smooths out the price action over a longer period, giving us a better understanding of the overall direction the market is moving. On the other hand, a 20-period moving average is more useful for determining short-term trends, as it reacts more quickly to recent price changes and provides a snapshot of the market's current momentum. Some of the most commonly used moving averages are the 20, 50, 100 and 200 period averages. These are widely recognized by traders and investors alike. In general, moving averages serve the purpose of helping us identify the prevailing trend in the market, while also simplifying the price action to make it easier to interpret. Now, let's dive deeper into the specific ways moving averages can be used to make more informed and effective trading decisions. By understanding their practical applications, you can better navigate the market and increase your chances of success. The moving average is a versatile tool that primarily serves 3 main purposes in trading. First, it helps us identify the trend. Second, moving averages are used to identify trend changes. Third, moving averages can be used to identify areas of support and resistance. These 3 uses of the moving average are critical for making more informed decisions and improving your overall trading strategy. Let's begin by understanding how to identify the trend using the moving average. The moving average is a trend indicator, so its primary function is to help us determine the direction of the market. To do this, there are 3 main techniques we can use. First, we look at the price versus the moving average. The position of the price relative to the moving average can provide a clear indication of the market's trend. If the price is consistently above the moving average, it signals that the market is in an uptrend. As logical traders, we want to trade with a trend, so in this case we should focus on finding buy opportunities. On the flip side, if the price is below the moving average and has remained below it for an extended period, it suggests that the market is in a downtrend. In this scenario, we should be looking for selling opportunities. Lastly, in sideways or range-bound markets, the price tends to oscillate above and below the moving average without staying in one direction for long. It moves like a pendulum, switching positions frequently. In these situations, it's best to avoid trading and wait for a clear trend to form before entering the market. A simple and effective trick for improving your analysis is to use 2 moving averages with different period settings. This way, you can get a clearer picture of both the short-term and long-term trends in the market. Here's a simple example to illustrate this. On this chart, we have 2 moving averages. The yellow line represents the 20-period moving average, while the blue line represents the 200-period moving average. The 20-period moving average is a short-term moving average, so it helps us identify the short-term trend of the market. On the other hand, the 200-period moving average is a long-term moving average, giving us insight into the long-term trend. Now, let's temporarily ignore the 200-period moving average and focus solely on the 20-period moving average. Looking at this, we can see that whenever the price was above the 20-period moving average, it was in an uptrend, suggesting that we should be looking for buying opportunities. Conversely, when the price was below the 20-period moving average, it indicated a downtrend, which would lead us to focus on selling opportunities. However, upon closer inspection, we can see that there wasn't much price movement during the downtrend periods. Now, if we bring the 200-period moving average back into the analysis, we can observe that the price stayed above the 200 moving average throughout the entire period. This indicates that the market was in a long-term uptrend. With this additional information, we can conclude that selling during these down periods would have been risky, as it would be going against the overall long-term trend. Here's another example to consider. When we zoom in on this section of the chart, we notice that the price is moving around the 20-period moving average for an extended period. This indicates that the price is in a short-term sideways trend, as it's bouncing around the moving average without showing a clear upward or downward direction. However, at the same time, the price remains consistently above the 200-period moving average. This suggests that, from a long-term perspective, the price is in an uptrend. So, we're dealing with a sideways trend in the short term, but with a long-term upward bias. In such a situation, we have a couple of options. We could avoid trading altogether due to the lack of clear direction in the sideways market, or we could place buy trades near the lower end of the range, where the price tends to find support. What we definitely shouldn't do is enter sell trades at the upper end of the range, because that would go against the long-term upward trend. By using two moving averages, you won't necessarily get better trade opportunities, but it will certainly help you avoid making poor decisions. It's all about aligning your trades with the overall market trend and using the right information to steer clear of risky moves. If you're enjoying this video so far, make sure to like it and subscribe to our channel so you never miss any of our future videos. Second, let's talk about the moving average slope. The slope of the moving average is another key factor that gives us valuable insight into the strength of a trend. When the market is in an uptrend, the moving average will slope upwards. In a strong uptrend, the slope of the moving average will be steep, almost reaching a 45-degree angle. On the other hand, in a weak uptrend, the slope will be much more gradual, indicating that the upward momentum is not as strong. The same concept applies to downtrends. In a strong downtrend, the moving average will have a steep downward slope, again near a 45-degree angle, reflecting the strength of the selling pressure. In a weak downtrend, the downward slope will be more gentle, suggesting that the downward momentum is losing steam. This information is incredibly useful because it helps us gauge the strength of the trend. If the trend is strong, we can afford to be more aggressive in our entries, taking advantage of the momentum. However, if the trend is weak, we need to exercise more caution with our trades, as the market may reverse or lack sufficient momentum to continue in the direction we want to trade. Third, let's talk about using large versus small moving averages. Another effective way to identify the market's trend is by using two moving averages and analyzing their relative positions. For example, we can plot a 50-period moving average and a 200-period moving average on the chart. The 50-period moving average is referred to as the smaller moving average, while the 200-period moving average is the larger moving average. When the smaller moving average is above the larger moving average, it indicates that the price is in an uptrend. In this case, we would focus on finding buying opportunities, as the market is showing signs of upward momentum. On the flip side, when the smaller moving average is below the larger moving average, it signals that the price is in a downtrend. As logical traders, we would then look for selling opportunities during this time, aligning our trades with the overall downward trend. This method helps keep our trades in line with the prevailing market direction, allowing us to make more informed and effective decisions. So, these were the 3 techniques that you can use to identify the trend using the moving average indicator. Now let's move on to learning how to use the moving average to identify potential trend reversals. To spot a trend reversal, we have 2 primary techniques. First, price crossover. As we discussed earlier, during an uptrend, the price tends to stay above the moving average, and in a downtrend, the price stays below the moving average. By using this same logic, when the price crosses below the moving average from above, it signals that the uptrend has come to an end and a downtrend is about to begin. This crossover indicates a bearish reversal in price. On the other hand, when the price crosses above the moving average from below, it suggests that the downtrend is over and a new uptrend is starting. This crossover signals a bullish reversal. However, keep in mind that not all crossovers are reliable signals, and many of them can turn out to be false signals. To minimize the risk of these false signals, we can also use a moving average crossover strategy, which typically involves waiting for confirmation from additional indicators or multiple moving averages to increase the reliability of the reversal signal. A moving average crossover is one of the most popular ways to use the moving average indicator in trading. To apply this strategy, you need 2 moving averages with different period settings. For example, we can use the 50 period and 200 period moving averages as we did earlier. Previously, we learned that in an uptrend, the smaller moving average is positioned above the larger moving average. Conversely, in a downtrend, the smaller moving average is below the larger moving average. Building on that logic, whenever the smaller moving average crosses below the larger moving average, it signals that the price has shifted from an uptrend to a downtrend. This crossover indicates a bearish reversal, suggesting that the market is likely to continue downward. On the other hand, when the smaller moving average crosses above the larger moving average, it indicates that the price has shifted from a downtrend to an uptrend, signaling a bullish reversal and suggesting that the market is likely to rise. While these crossovers can be powerful signals, we don't recommend entering trades based solely on these reversals. Instead, you should combine them with other factors or indicators to make more informed and accurate trade decisions. So, these are the 2 main techniques you can use to identify trend reversals with moving averages. We are now moving on to one of the most important uses of the moving average, identifying dynamic levels of support and resistance. When we talk about support and resistance in traditional terms, we refer to fixed price levels where the price is expected to reverse. However, moving averages can act as dynamic levels of support and resistance, meaning they adjust and move with the price action over time. In an uptrend, the price tends to stay above the moving average. Whenever the price pulls back to the moving average, it often finds support there, meaning that the price has a tendency to bounce off the moving average and continue moving higher. This gives us a potential opportunity to enter buy trades near the moving average as the trend is still intact. For example, in this scenario, the moving average provides support to the price on 3 separate occasions, each time helping to push the price back up. By recognizing these dynamic support levels, we can better time our entries and align them with the prevailing trend, increasing our chances of success in the market. On the other hand, in a downtrend, the price generally stays below the moving average. Whenever the price approaches the moving average, it tends to face resistance. This means that the price struggles to push above the moving average and instead reverses back downward. In such a scenario, we can look for selling opportunities near the moving average as the downtrend remains intact. In fact, in this case, the price encounters resistance at the moving average a total of 5 times. This is how the moving average can act as a dynamic level of resistance, guiding us to better identify potential areas for selling during a downtrend. By observing these resistance levels, we can make more informed decisions on when to enter trades, aligning with the prevailing market direction. And with that, we've reached the end of this video. Throughout this video, we've explored how to effectively use the moving average indicator in our trading strategies. By now, you should have a better understanding of how this tool can help you make more informed decisions in the market. If you found this video helpful, please make sure to hit the like button and subscribe to our channel so you won't miss out on any of our upcoming videos. Thanks for watching, and I'll see you in the next one.